Hello, everyone. Hope you're having a good time today. Great. So I'll welcome the other panelists on the stage. Let me sit up the side here. So we're going to talk about venture capital with a provocative title of, will this industry, venture capital, even be relevant 5 years from now? And I have some great panelists to discuss this with. So to my right, Sheel Mohnot from 500 Startups in San Francisco, Hussein Kanji from Hoxton Ventures in London, and Patrick Bachman from Open Ocean in Helsinki, Finland. So thanks, guys. And I actually want to start, so how many of you out there are venture capitalists yourselves, investors? There's a handful of hands. So probably most of you don't maybe know the details of how the venture capital business model works. It's actually not necessarily what you think. And maybe Hussein, if I can ask you the first question, if you can give us sort of some idea of, what is venture capital? How does a venture capital fund work?
Sure. So venture is a pretty easy business. We run a fund. Most of us tend to raise money from external people, and we put a bunch of money in ourselves into our own funds, usually about 2 to 5%. But the bulk of our money usually comes from external investors. In the US, it's predominantly university endowments who usually don't need the money anytime soon and are investing for growth and returns. In Europe, it's mostly taxpayer money, usually from a government one way or the other, because in Europe there hasn't been as much in the way of returns, so the government's trying to prop up the industry. We take this money, we hold it for about 10 years. The first 3 or 4 years, we use it to invest into companies. The remaining time, we use it to not make new investments, but to continue investing in the companies, but also then to, when the companies exit, we distribute the money back to our investors. For this service, we charge roughly about 2% of the funds under management to run the business. That declines as the fund gets a little bit older. And then whatever profits we make, we share them with the investors, usually about 80-20. So 20% goes to us as the fund managers, 80% goes back to the investors after they get all their money back. And every 3 to 4 years, we raise another fund in order to go off and make a bunch of new investments again.
So basically the trick to the business is to buy shares in companies when they're younger at a lower price and sell them. So some of them go out of business, right?
Exactly. I mean, on the whole, about in the industry average is about 35 to 55% of our businesses that we invest in. The shares are worth less than when at the time of the exit than the price that we paid. They either go out of business, they get acquired for less than what we paid for them, and then the good companies tend to make us the bulk of the money. And usually for most good venture funds, it's 1 or 2 companies in the fund that return not just all the money back for that investment, but all the money back for the fund, and usually in multiples of the fund. So, you're a $100 million fund, you make a $5 million investment, and you get back $300 million, which basically returns your entire fund. So it's not a consistent business. It's very much of a making sure the right company's in your fund.
Yeah, so it's a very strange business from sort of a business point of view. So Sheel, maybe tell me a little bit about how the advent of ICOs is, creating discussion in the VC industry about whether we should be doing this completely differently in the future.
Sure. So how many of you guys are familiar with ICOs? And how many of you participated in an ICO or own a token? Okay, many fewer hands. Okay, cool. So I see this ICO, first of all, it means initial coin offering, which is a funny play on IPO. And there are 2 different types of ICOs. One is a utility token, so to speak, and one is a security token. A security token is basically offering shares in a company, equity in the company, the same way that you can go out to venture capitalists to raise money. You can go out to the crowd, so to speak, and raise money. My view, and the chairman of the SEC yesterday shared a similar view, is that all these other tokens, which are utility tokens, will also ultimately be regulated as security tokens. So utility tokens are tokens that supposedly just have some utility in a network. Most prominently, most used for network effects businesses, where if it's better for me if other participants are involved in the network, and then the value of my token increases over time. So one example would be Airbnb. If instead of transacting via money, there was an Airbnb token, and then you'd be incentivized for participating on the network as a host, but also convincing other people to stay at properties. Now, people tend to think, many people think, that why raise money from a venture capitalist when you can raise a bunch of money from the crowd? And the crowd is mostly people who have made a lot of money in the crypto world, either by primarily Bitcoin and Ethereum. And the challenge is venture capitalists actually serve a purpose, which is like coming in and giving you an assessment of the company, valuing the company fairly. I think 99% of the ICOs that happened in the past couple of years have been at a price that venture capitalists would not pay. So projects with not a full team developed, no product, have raised $200 million, for example. That would never happen in the venture capital world, or unless there was some spectacular team involved. So I think is the future bright for ICOs? I think it's possible. Does it completely negate the need for venture capitalists? I don't think so. We were talking earlier that in the Baltic region there has not been a lot of venture capital activity, but there have been a lot of ICOs. So I think in certain regions it could have a lot of value, including the Baltic region.
Mm-hmm. And so, Patrick, maybe so you're probably talking to entrepreneurs about this on a regular basis. So what do the entrepreneurs say?
Well, I have to say, I mean, I have a background from MariaDB and MySQL database companies, and being part of these open source companies, they often create a lot of exciting technologies, and they used to have almost impossible to commercialize. Well, we managed to do it in these two companies, but 99% were not able to really commercialize effectively. And I think the ICOs actually enable really cool technologies to be developed and commercialized in a way that wasn't possible before. So we even talk about a kind of a new age of open source in terms of crypto and what it enables.
Okay.
But then I would add to your comment that actually what many of these founders really need is help and advice and so forth, and you can effectively get funding and support and financial muscles from tokenization and ICOs, but what you also need is help and assistance, and that is something that smart investors or advisors can give you.
So, but why don't you just issue a token, raise 20 million, and buy the advice?
Yes, you can do that.
Mm-hmm. Okay.
And I think that will actually change quite a lot of the industry in 10 years or so. Of course, there will be stumbling blocks and difficulties and regulation and many things will not work. But some models will work where actually yes, kind of the ICO kind of concepts will emerge as a big force in how startups are financed and get going.
But so, Hussein, do you then envisage VCs also investing in tokens?
So it's already happening. So, you have this pool of money that is largely dumb money. That's what most coin offerings are. It's not institutional investors doing a ton of research and analysis. It's people taking a punt. And usually, there's lots of academic evidence around retail money. Retail money is almost always the dumbest money in a market, whether it's in the stock market or the bond market. And I wouldn't be surprised if it's the same in the crypto market. So the way you deal with dumb money is you put a little bit of money into the company, you help them then go raise a lot of dumb money, and everyone who's on the inside benefits, and everyone in the venture game has figured this out, and most of us have adjusted or are adjusting our limited partnership agreements, which govern what we can invest in to enable these kinds of things. So the smart money is already using the dumb money effectively in the same way the smart money figured out how to use Indiegogo and Kickstarter for hardware-oriented campaigns, or in the UK for crowd-funded retail campaigns. A lot of those things get funded by retail money because it's cheap capital. In many cases, it's close to free capital.
So you would advise founders to sort of select a VC. So if they're thinking of doing a token offering, select a VC for Like
The
help before doing the ICO?
So a few years ago, the ICO market was such that you could do pretty much everything by yourself, but now the cost is a lot higher. You have to spend some money on marketing, you have to spend some money on travel to go meet the whales. The industry's developed, so it's no longer, you can't pull off an ICO for $50,000 and just put your savings into something. You probably have to burn $500,000 or $1 million to be able to pull off a very successful ICO, which means you have to go find a $500K to $1 million or $2 million. So people are doing it with the likes of the bigger venture funds and then going off and raising the 20, 30, 50, billion on the ICO market.
Mm-hmm. I mean, the venture funds are often just serving as a signaling mechanism. So oftentimes they'll want our money, but not very much of it. Which is unlike how it typically goes, because all they want our money for is the signaling mechanism that it sends to the market. And similarly, they'll bring on advisors just for the signaling aspect, not for any real advice. So
signaling mean you showing people that if this guy's actually putting money in the company, it's worth buying the token.
Exactly.
Yeah. And so you guys are implying sort of the VCs will add value, right, in the money they put in. How do you suggest a founder measure that? How do they figure out which VC is actually going to add value? Who wants to take that?
Well, when they, of course, choosing an investor into your company, any company, is a very big, decision to make. It's like marriage or something. You can't really, move in and out from an investor well. So you should really evaluate, what they've done in the past, and also talk to other companies they have helped and other founders they worked with to see what was it really like to work with them, because that's more or less the only thing you can check. Of course, the VCs often are good at might be good at talking and can give a good picture of themselves, and you can hear their advice, which you should, but you should also check from other sources.
Yeah. So Hussein, how often do founders do this?
So I'm incredibly bearish on the idea that venture investors add value. For all the value that we add, we destroy far more value inside of a company with our informed opinions. Right? What venture guys can do super well from a value perspective is most companies that start to succeed need to hire, and our network usually can help you triage who to hire much faster than a founder can do alone. So we can help build teams in this background type way. And then oftentimes we're more connected than the average founder, and so we can make stuff happen behind the scenes. You're doing a strategic partnership with Google. We can pick up a phone and call someone who's an executive at Google. We probably can't get the deal done, but we can make it happen a hell of a lot faster. Those kinds of things are reasonably value add. When we try and interfere and tell businesses what to do or how to build the businesses, we are almost always, as investors, the dumbest people in the room. And we should be the dumbest people in the room, because if you're not investing in someone who's 100 times smarter than you, I don't think you're doing it right. So then all your information is secondhand from the founder. It's not firsthand, right? So maybe use some general patterns of how to do business, but your ability to actually add real value is pretty minimal. In the ICO market, by the way, I don't think this is a value add game. I think this is a rubber stamping game. If you get money from a well-known venture brand that knows how to successfully invest, you're effectively getting a rubber stamp on, or a seal of approval, kind of a good housekeeping approval, that your business is probably better than 99% of the other noise that's in there, which makes it easier for you to go off and get money from the crowd.
Mm-hmm. But does that differ for first-time founders or serial founders?
I mean, the other way of getting a good housekeeping seal is, you build something that's just incredibly obvious to everybody, right? You go build a rocket ship that goes to Mars and it actually works. People will line up to give you money because that's a really hard thing to do. The other way of doing it is you've built $10 billion businesses before. Again, it's reasonably easy to, for people to believe that you'll build the 11th, but most people don't fall into those two buckets. So sometimes it helps to have a Sequoia or a 500 Startups or someone who's a well-known brand affiliated with the project, because it takes you above all the noise.
And Sheel, so what about VCs? Why don't VCs just issue tokens?
Like raise their funds via tokens? There have been a few that I can think of. Blockchain Capital was the first to do it. More recently, there's one called Spice VC, and there's one in LA called Science, an incubator that raised via tokens. It's actually, I think, it's not like a golden ticket. It's not like you put your information out there and a ton of investors want to invest in your fund. Science actually tried to raise $100 million, and last time I checked, they had only raised $13 million. despite being the incubator behind Dollar Shave Club, which sold for $1 billion, and a few other things. So I think there's not really a huge advantage to a VC fund raising via token. Like, you're going to go out and do a roadshow and get investors to invest, and likely you want large investors. So like, I don't see the benefit of doing it via token.
You could get 10,000 investors all putting in smaller amounts.
If you're a U.S. fund, you can't. You're
because of SEC regulations.
Yeah, so you can only get 99 investors anyway. So there's really no point if you're a U.S. domiciled fund.
Right.
So it's really a shame that Richard Muirhead is not here, our partner, who was supposed to be here, but his flight was cancelled. So because we're together with him launching a crypto blockchain fund. So he could talk more specifically about the details here.
He's raising a crypto fund, but is he raising it via token sale?
At the moment, I think not, but its exact structure is being worked on. But we recognize, OpenOcean, we have a number of funds and an equity strategy, so to say. So we're keeping that, and we actually didn't go to LPs to start to change it, but we're launching with Richard under Fabric name. Fabric.vc, a new kind of blockchain crypto-focused thing, because we see how important it is for the future of software industry.
Yeah, from raising a fund perspective, most of the really good funds have investors lining up to invest in them, so they don't need the money. Most of the not so good funds struggle to raise money, but almost rightfully so, because they don't make that much money. And so if there's free money available in the crowd, they would go for it. The challenge for us is we're really long-term investors, right? It takes years to build a business. Tokens are all about short-term liquidity and having a mark-to-market and being able to trade an asset. Our asset doesn't get traded because we hold shares in these private companies that take 7 years, 8 years, 9 years to build until they actually become formative real companies. And so if you have investors behind you, who are trading this thing, they're trading something, which is fine for you because it's irrelevant to you if your investors trade behind the scenes. But it doesn't move for years, right? And like 5 years can go by, 4 years can go by, and it just looks like your venture firm is not doing anything. It's just the value just kind of stays static. In fact, it actually declines because you're drawing these fees. So it's not very synergistic as a fund to offer liquidity. Like, it's just not part of the value proposition of venture. We're in a liquid asset for a reason, because we need to hold our shares in these companies for a long time to watch them grow up. And all of our returns come from that one or two that grow up massively. So you don't want to trade out of something until you know that the one or two are going to happen. And it's going to take years for you to be able to figure that out.
Yeah, they say it takes 10 years to figure out whether you're any good at venture capital, right?
10 years and $30 million per person.
And you still might not be good. You could just be lucky.
Yep.
At the same time, though, with ICOs and tokens, you can launch companies that wasn't possible before. And at open source companies like MariaDB and MySQL, we had communities of millions of users that gave us a lot of good value. But now with tokenization, you can actually get a community of token holders that actually can drive your success. And that kind of incentivization didn't exist in the last open source generation, so to say.
So, but let me ask further on that. But that means the developers using that open network, they need to buy into the token at some point. They need to pay some kind of even a low cost initially to get into the network, right?
Those that kind of you define let's say a new HTTP protocol or something, but then those who believe in that concept and can influence, driving it popular, they can also, get incentivized and buy into that and then help spread it and then earn themselves. And in that way, really, it's a model that didn't exist before. So there we talk about value from VCs. This is the value of the community, so to say, which can be realized in a new way.
Look, the absolute, if you're a young company, the absolute best money in the world that you can get is money from your customers. Like, forget about investors, right? Getting money from people who are going to pay you because they think that something is super valuable is the best money in the world. It's non-dilutive, right? It's revenue, right? It will generate, if you can cover your overheads, profits. And it's validation that people actually care about what it is that you're building. If you can leverage that with equity investment and get money from your customers who are also willing to invest in you in small ways, right? That's also really, really powerful. My biggest worry about the whole, so this ICO stuff makes a lot of sense for things like that. My biggest worry is like 99% of it is a scam. Like most of these companies are just BS companies raising money at like high prices because they can get away with it, which is only going to destroy the entire economy because the regulators will come in, people will lose money, regulators will come in to stop it, and then all of a sudden all the good stuff gets thrown away with the bad stuff.
And becomes too expensive to issue proper tokens because the regulation.
You end up with like the Sarbanes-Oxley equivalent of the ICO market. You'll kill the market.
Yeah. So if you talk to a founder today, would you require them to tell you whether they're going to do a token after you invest at some point?
I think at the core it's about building, something that a software that is meaningful, valuable, gets spread and used and popular, and that you can commercialize, and building a sustainable business in the end. Then the method for doing it, for some concepts, yes, token works. I think still the traditional model will work in most other models. It really depends on the kind of use case, the thing you're building, your vision, and so forth. There's not a simple answer. Then, of course, gradually, if kind of all kind of these kind of security tokens, if they will be, standardized in some form, yes, it might shape the whole VC industry more. But today I would say it's more about what you're building and how you want to make it successful.
We're totally okay with that, whatever the founder wants to do, right? So if that's the right thing for the business, we'll back it. But I think in general, of the people that we have seen come to us with tokenized offerings, they are among the worst pitches that we have seen and the worst founders that we have seen. They are the people who cannot raise money from the venture community, so they're going to the crowd. The best is people who could absolutely raise money from the venture community, but are choosing to go to the crowd. But we don't see very many of those, unfortunately.
The thing, I'm doing a deal right now in a company. It's a friend of mine. He's actually founded a fintech unicorn, $1 billion plus company. And he's actually going to do a token sale for this new company. And, I'm investing at the seed stage of the company, equity side, not the token, but it's at a $45 million pre, because we know that he can raise $100 million through the utility token aspect of it. So when these opportunities do come along with a legitimate company, it comes at an extremely high price, because there's cheap money behind it. So this company will be well capitalized and probably never have to raise money again.
Great.
Yeah, but I do agree with Hussein here that 95% of the tokens and ICOs out there are probably not long-term sustainable. So there will be a kind of, we're probably around the top of the hype, there will be kind of some the market coming to a realization about that. But then I think the next, it's like the dot-com boom, the next then healthy curve that will start will be sustainable, more sustainable and credible, and something to definitely consider investing into.
Great. All right. Well, thank you guys. Appreciate the time.
Thank you.
Applause for the panel. Thank you.